What's up, everyone? It's Scotty with MoneyVest. So in this video, we are going to be talking about the bond market, and the 10-year yields seems to be on a mission right now. And not only that, I'm going to break down the market, in other words, the market breadth, and talk a little bit about how this one index is now negative on the year, which should be alarming to a lot of people because, without technology, without the help of magnificent 7 or 8 stocks, we're not really going anywhere on a year-over-year basis. So hope you guys enjoy this video and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Links to our Discord and Patreon is going to be down below if you're interested in joining. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, members-only private videos, trading view charts, research reports, which we are going to be introducing in October. So links are going to be down below, and we'd love to have you on board. And there's 2 more days left for that discount. So again, we'd love to have you on board. Link's going to be down below. So this right here is the catalyst. So morning bid, bond crush stifles markets as $134 billion hits the market. So renewed surge in long-term Treasury yields is stifling world markets yet again as Federal Reserve officials hang tough on one more rate rise, which we have talked about in our last week's video. I went over everything from an FOMC standpoint. We talked about, what Jerome Powell talked about, the summary of economic projections. We talked about every single little detail with respect to the Fed meeting. So make sure that you do go back, check out those videos if you want to, again, get in sync with what's going on and be on top of everything. But $134 billion of new government debt sales hitting the markets this week, and a government shutdown also looming over the markets as well. So if you come over to what we have witnessed, of course, September so far, the S&P is down a little bit over 5%. The NASDAQ is down over 6.7%, so almost 7% down in the month of September, and we still have 3 more days left. And I also want to point out the U.S. 10-year Treasuries. Look at that move. They're up 13.6%. They're up another 1.3% on the day today, getting up to almost 4.7%, folks. Like, this in itself is a big indicator, because we are now once again getting to the same levels as September of 2007, right? So this is literally back in September 2007. So that is about 16-year high on the yields, and a very strong move to the upside in the month of September. If we get up to 6.5%, 7%, 5% even, that is going to be detrimental to the health of the market. And the reason for that is very simple. It's an obvious, more logical reason. And this is a base rate, right? The 10-year yield is literally the base rate for the market. Everyone is looking to beat both inflation and the 10-year yield, because people can get 4.5%, 5% right now very easily. Even money market accounts are going to pay you 4%. The 10-year yield is going to pay you 4.67%. And not to mention, there's a lot of other yields more on the shorter end of the curve. So if you come over to the chart where we have all the yield curves, you'll notice that right now we have, shorter end of the curve. So for example, a 3-month sitting at 5.5%, 6-month at 5.56%, the 2-year sitting at over 5%. These are detrimental rates. These are not these are not favorable rates for equities, because again, bond yields and equity prices are supposed to move in inversely to each other, because as yields go up, guess what? More and more people, more and more investors start to become more attractive towards those bond yields, and prices, stock prices and equity prices start to come down because they become less favorable in an environment where rates are higher, because investors can get that 5%, 6% investing in bond yields versus in equities, right? So if you come over to this right here, $134 billion, obviously hitting the market. So now when we look at $134 billion, once again, hitting the markets, that's additional supply coming into the markets once again, and that's going to lower the prices, which is exactly what we're seeing with TLT and TMF. TLT is down over 8% in the month of September, down another 1% pre-market. TMF here down a little bit over 23% this month, and down another 3.7% pre-market to 462. And this is exactly one of the reasons why I have mentioned to be patient with this macro tactical play, because yields are on a mission. They are going to not stop until there's a normalization with the amount of supply that's hitting the market, both on the corporate and the government side, right? Because, and of course, that's causing the dollar index to push higher as well. You can see the dollar index is up 2.7% in the month of September. May not seem like a lot, but that's a pretty sizable move And it's obviously, causing big tech and, of course, multinationals that do operations outside the US to also pull back because their non-US dollar earnings are going to be worth less when translated back over to US dollars. So those are things to keep in mind because these are very important indicators and technicals that are basically driving the markets right now. And we have seen that correlation not play out for a very long time. So basically, if I, put together the S&P 500 on this chart, right, that's going to be on a new pane or a new price scale, you'll notice that for the longest time, it didn't quite work. In other words, as the yields were pushing higher, so were the markets, right? So it was very recently, let me just go ahead and put these as candles. Let's do that. Boom. There we go. So you can see that up until just a few months ago in June and July, that correlation was starting to break apart because they were both moving in the same direction. We've got the yields pushing up and we've got the S&P 500 pushing up. Hopefully you guys can see that despite the technicals that I just had to bring up. Let me just remove that. So this right here, the yields pushing higher and the market's pushing higher. But now look what's happened in the last couple of months. We've seen the yields move up and of course the S&P 500 has started rolling over, which is how it's supposed to be had, right? Which is how it's supposed to happen because again, you can see both of them have moved in the opposite direction as the yields, as the S&P 500 has come down, yields have pushed higher. And even in the past, it's played out perfectly. Now, what's also interesting with this sort of a dynamic here is that we're seeing other stocks also sell off, and technology is basically or has been the one that's leading the way so far in 2023. And now, if you account for all stocks, all 500 companies in the S&P 500 equally, so in other words, the S&P 500 equal weighted index, it is now red. It is now negative for the year. So if you come over to RSP, you'll notice that it is down a little bit over 5.5% in the month of September. And it is down 70 basis points on the year. So on a year-over-year basis, S&P 500 on an equal weighted index is down significantly. This is obviously the weights and the gains on a year-to-date basis for these companies. So Apple, 7.1%, right? We got Microsoft at 6.5%, we got Amazon at 3.2%, and collectively all these 9 companies make up over 29%, a third of the market cap in the S&P 500. That's ridiculous. And gain year to date, again, nothing shy of 30%. Nothing is less than 30%, except for Berkshire Hathaway, which is 15%. Everything else up at least 30, 45, 50%, some even in the triple digits, like Meta, Tesla, and Nvidia, right? Hundreds of percent. And this right here is the divergence, which has more recently started to play out, where the equal weighted index is now, once again, significantly underperforming, which is obvious because technology has been the big leader, and it is performed much better than the equal weighted index. So knowing that, I think it's very, very fair to assume, I think it's reasonable to assume that there is going to be on an S&P 500 basis, and again, this is not a prediction or it's not a forecast because I don't make forecasts, I don't make predictions, I want to be very clear. But as yields continue to push higher, well, guess what? They are going to put an impact on the big tech. They are going to put impact on these companies, on these Magnificent Seven. So both the dollar pushing higher and the 10-year yield pushing higher is going to affect these companies, right? At some point. It's going to. It has to because that's the risk-free rate, which is being used as the base rate. Everything needs to beat the base rate, which is the 10-year yield, which is pushing higher and higher. So what happens is that as your 10-year yield starts to push higher, the reward needs to also increase because that's the base rate that's going higher. So in other words, the discount rate will be higher and higher at 14, 16, 18%. And that is going to lead to a lower intrinsic value, right? So when we do our calculations for fair values, if the base rates continue to push higher, which is the 10-year yield, if it gets to 5, 5.5, 6, 6.5%, well, then guess what? Our discount rate needs to go up as well because we need to be compensated, right? If we're investing in individual stocks, we need to be compensated with a higher rate of return so that discount rate will go up, which will thereby lower the intrinsic value, the fair value on these companies. So keep that in mind. And of course, equal weighted index definitely selling off quite aggressively, more so than the S&P 500 and now negative on the year. But let me know in the comment section down below, what do you think about the market dynamics right now? I did a video on the risk analysis and the sentiment of the overall market in one of my previous videos. So do check that out if you have the time. But right now, 10-year yield definitely causing a lot of problems for technology and of course for the overall market. If it gets to 5.5, 6%, I think that can really be damaging to the overall economy and the market. So that's something to keep in mind. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. 16% annual discount that's available till the end of this month. As always, happy investing. I'll see you all in the next video.